Good afternoon. Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we wanted to talk about a topic that is on a lot of people's minds. It's constantly talked about on the news, and that is the concept of recession. And are we, in fact, expecting to see a recession in the near future? And the truth is that no one really knows. Nobody knows when we're going to be entering in a recession, and even when we're in a recession. Usually that's something that people see in hindsight. And so we wanted to talk a little bit about that because it's important to understand that what you really want to do is you want to be prepared for the fact that we might have an economic market downturn. Rather than predicting it, just know that it is possible and have your ducks in order so that you are prepared.
That's right.
This list here shows really all of the recessions since back to the 1950s. There were a couple of recessions even earlier on in the 1900s that we experienced. But in most cases, these recessions lasted, most of them lasted around 11 months, with the exception of, for example, 2007 lasted much longer. But what we found interesting when we were looking at these different recessionary periods was during the recession, what the stock market did as measured in the S&P, and even 1 year prior. And in some cases, the market actually was fine during the recessionary period. Leading up to the recession, it wasn't as fine. And so it's not as fully correlated as people think, that just because we're in a recession, we're automatically going to have a market downturn.
And I want to mention something. It's really hard to predict when a recession is going to occur. And most economists don't really have great track records of predicting when they're going to occur and how long they're going to last, that type of thing. You may occasionally see somebody who apparently was right about predicting a recession, but you have to look at all the other 50 economists versus the one that might have been able to accurately predict it. It might have been 49 that are wrong. And so that's the problem, is who should you listen to?
Right.
And there are a lot of things that can happen in an economy that are not particularly predictable, especially external forces. For example, COVID 2 years ago, the war in the Ukraine, a lot of other things that were very, very hard to predict, very much in advance. So,
although one thing that I would like to mention, though, is in a lot of these instances, the one thing that's got, I think, a lot of people jittery, and even us a little jittery, is that even if we look at 1953, 1957, both of them, like 1953, the recession really resulted from a tightening of the monetary policy following the Korean War. 57, it was also a contractionary monetary policy. I'm not sure as much. I know in the 60s now we had some things regarding, I know Kennedy was doing some things with stimulus and stimulus spending, and
he cut taxes substantially. Actually, under Kennedy, he was for cutting taxes, believe it or not, and I believe he did, and I think that helped pull us out of the recession. I don't recall reading about why that recession occurred in 1960.
I know there was some unemployment components to it. 1969, I guess that was a relatively mild recession, I think, but 73 to 75 was a big one. That lasted for almost 2 years, and that was the OPEC embargo.
That's right.
And all that created a lot of problems. And that's actually when Nixon wound up taking us off the gold standard.
And he also tried something foolish. He tried to control prices and prevent price increases in the economy, and that'll never work. You can't do that. And that was a huge mistake. Nixon really wasn't the best when it came to economic policy.
Right. Well, we wound up with a whole lot of stagflation for a long time as well, which is one of the fears that we've talked about, which is when unemployment also starts reaching real highs, and it's just not a good thing.
1980 and 81 was when Paul Volcker was heading up the Federal Reserve, and he was trying to wring inflation out of the economy, because inflation is really destructive to an economy in the long run. And so he wrung it out of the economy by raising interest rates and also by clamping down on the money supply and exerting greater control over it and the growth in the money supply. And that's what led to those recessions, I think in 80 and 81.
Absolutely. And 91 was the S&L crisis.
That's right.
Higher
That's
interest
right.
rates and,
Which many of us have forgotten about, right?
right. Also, the Iraq's invasion in Kuwait.
That's right.
Right. And then 2001 was the dot-com business
Implosion.
bust, if you will. And then a lot of people do remember in 2008, 2009, it was really because of the subprime mortgage crisis. So there are usually these drivers behind this. And one of the concerns I think that we have is, what is the government going to do? Because oftentimes their intervention can cause some more difficulty. And so that's why we're very watching what they do. We are expecting, today is, I guess, a day that a lot of people are on pins and needles waiting for the Federal Reserve to come out, but we are expecting some increase in the Federal Reserve rate.
And by the way, regarding the government, whatever side you lean toward, and we're not going to comment on that, but a lot of times intelligent moves from the government, so politics supplants good economic policy in many, many cases. And in some cases, that's actually led to recessions, in particular the housing crises. The government, through Fannie Mae and Freddie Mac, gradually reduced lending standards, and that helped lead to the mortgage crises and the housing crisis in 07 and 08 and 09 also. So.
Mm-hmm.
So I guess you want to define a recession, right? At least, I think Laurie said it was somebody defined it in the 1970s originally, and said that a recession is actually.
The New York Times posted, they posted what it was because people were confused on what caused a recession.
Sure. It's 2 quarters of negative GDP growth. In other words, 2 quarters of the GDP shrinking. That's the formal definition of a recession. And there's other signs that you've brought up here.
Well, the thing is that it's difficult for the NBER to actually know when there are declines in economic activity. And
that's right.
So they look for other items, and a couple of the key areas that they look at is they look at what's going on with manufacturing, what's going on with jobs, are there openings, and are people able to get jobs? And usually all of these things, what they're looking for is they're looking for declines that last at least for 6 months in these areas. So we thought we might look at a couple of these things to help us all understand.
Yeah, sometimes there's a little bit of a lag in some of this data too. So they don't always know until after the fact in some cases. It's always hard. Well, there's leading indicators that helps. That's another measure which we're not showing here. And the index of leading indicators is supposed to help provide some sort of signal. Now, I'm not even sure that's always entirely accurate either. No.
This chart just shows the composition of what makes up gross domestic products. And it really is heavily weighted by how much we as consumers spend. 70% of gross domestic product has to do with how we spend our money. And right now, we're not seeing a terribly significant decline in that. There continues to be spending in that area.
There was a slight decline in December, but the 3 months that we have of data since then, consumer spending has increased each month.
We also see increased growth or at least consistent spending in domestic investment, which is the purple section, which is where companies are actually investing in their own companies as well.
And that's durable equipment. That's heavy equipment for production. That type of thing. So yeah, we're not really seeing any real contraction here yet.
Right.
Now this does show from quarter to quarter the increase in GDP, percent increase. And there was a decline for the first quarter, I think, of minus 1.4% in GDP. So it shrank by that amount. I guess the explanation that we've seen is that companies were refilling inventory, stocks of inventory post-COVID, and a lot of the supply chain was built back up, and so they stopped production or slow production, did not produce as much because a lot of the inventory had been backfilled, and so they believe that might have been the reason for the decline.
As opposed to a real harbinger.
Yes, yeah.
And just so when you're looking at the slide, you can see that this is really the change in GDP.
That's right.
And so as long as we're above that one single line across in the middle there, it's considered positive. And the couple of times where it took a dip, you can see there's a gray line usually behind it that shows that the gray lines indicate a recession. So you can say that it's consistent. A recession usually is consistent with the drop in GDP.
And these two huge spikes, which are, as you can see, are unprecedented, was due to COVID here. The decline when basically the economy was shut down, and the recovery, and it was almost like a rubber band. They pulled it and it snapped back, and it came right back once the economy opened up again. Post-pandemic, and they do have a little slight shading here, and it was such a short-lived recession. It was really tiny.
The other thing that the NBER looks at is manufacturing, and again, you can see against the gray lines that manufacturing tends to go down. Their output tends to go down during every recessionary period.
Yep.
We don't see a turn in that yet.
No, we don't. And it's astounding, the correlation. And by the way, manufacturing does tend to be somewhat of a lagging indicator. In fact, we talked about that beforehand. I think what happens is companies don't necessarily sense right away that spending has declined and consumer spending has declined. So they keep manufacturing at the same rate. And then they may finally get some sort of signal through their chains, retail chains and everything else that spending has declined, and so they start to cut back on manufacturing. But once that occurs, there's a high correlation between declines in manufacturing and recessions. So, and it's very evident from this chart.
And job openings, we continue to see increases in job openings. It's not that there aren't jobs to be had. We talked about that tiny blip, within the past month, but it's really not significant. It's not anything to really talk about because it does move.
Job openings are at a really high rate, and in part that's because we don't have the slide here or the graph, but the labor participation rate's down to about 62%. And there's a good chance that labor participation rate will probably start to increase. And you'll see these job openings start to be filled, and a number of job openings will decline here as well. And so it can happen because of two reasons. Job openings can decline because of a recession, or they can also decline because the labor participation rates increased and more people have come back into the workforce and filled those jobs. So that's sort of a dual aspect of this indicator.
Unemployment
is really low right now. But I will mention the labor participation rate is still low. It hasn't recovered completely since COVID. In part, that's because, frankly, the government was paying people to stay, not to work, and the unemployment, they extended it, and were giving people much higher unemployment payments. Mostly ended. I think it ended in September, much of it. So I think you're going to start to see the labor participation rate increase and the job openings decrease. And you may see this temporarily spike as more people enter the workforce again. But there are so many job openings, as we showed, 11 million roughly, that I don't think that any spike is going to really be that meaningful in the unemployment rate here. Okay. Anything else on this?
Yeah, well, The next slide actually shows us the U.S. Treasury yield curve and the fact
Hmm.
that it's flattening. Oh, actually, yeah. So this is the difference between the 2-year and the 10-year rate, and you would expect the 10-year rate to be higher, and it should be higher in a normal yield curve because you're actually taking the risk of holding that bond for a longer period of time. And so usually it's considered healthy when it's a normal, but when it compresses and when the 2-year, 10-year delta, the difference becomes much less or even flat, there is reason to be concerned. And honestly, in looking at yield curve inversions, it seems that most recessions have been somewhat um, uh, almost
Preceded.
forecasted by this
Yeah.
yield curve since going back to World War II. It's
Yep.
been an issue, and the problem is that we don't really know. Is it 6 months? Is it 18 months? Is it how far along will it be? We don't know that.
Well, you can see in 1995, it sort of occurred right here. I'm going to point it out right here. And a recession didn't occur for what, 8 years, 7 years after that, even though it happened. So it's kind of hard to predict whether it's really going to occur, and if it does occur, a recession, how leading this indicator really is.
Right.
So
And this other one also is another way of looking at the yield curve, where it just shows the different rates that you can expect if you were investing in a treasury or maybe even a CD type of investment. And that we see, especially in the 5-year, 7-year time frame, that those rates are actually even higher than a 10-year rate. And so you'll notice in your portfolios, anybody that we bought a recent bond piece, you probably are seeing bonds that are somewhere in that time frame, around the 7-year time frame.
yes, and I want to mention that at some point, probably in the next couple of weeks, we're going to be doing a video on the approach we take to bonds and where we do monitor yield curves and look for distortions in the yield curve. And some of you may have noticed that in some cases we traded your bonds, which we don't normally do, because it was the yield curve distortion we took advantage of.
Okay. So, in the end, experienced investors know they're unlikely to predict a recession, at least in time to flee the assets that they're currently in for any kind of safe harbors. And so, most experienced investors do understand that a diversified portfolio is an excellent chance of staying invested, recouping losses. And one of the things that we want to talk about a little bit further is, what do you do while you're in the middle of a recession? What happens and how do you position yourself as you're coming out of a recession? But the all-weather strategy does tend to be the ideal for us mere mortals who really cannot tell you exactly what's going to happen next.
That's correct. We don't know what the future is going to hold, and we don't even know the timing of various things. So having that all-weather portfolio is really the key in the long run to maximizing your wealth through different economic environments.
And we have seen time and time again people that have forecasted recessions or forecasted things that indicated that they should get out of the market, and they were always sorry that they did. It usually does not end well. When you try to start timing the market, we have very few stories, and Steve and I have been in this business for a long time and know many financial advisors, economists, and people that play in the space. And we have seen almost no stories of true success of being able to time the market. It just doesn't happen. So anybody that tries to tell you that they did try to time the market and they were successful and look at all the money they have, ask them to see their the last catch that they caught, their last fish, or
That's right.
It's a story, it's a fable that you probably should stay away from.
Well, we showed in one of our prior videos that the average return for the S&P after a recovery is about 25% in the first 3 months. And so to try to time that 3-month period and decide when to get back in the market is very difficult. And if you miss that 3-month period, you're missing a large amount of the return. And usually the market recovers very quickly at the beginning, and as it recovers, the return slows after that initial period. And so if you miss that initial period of recovery, you're going to really be hurt. And that's permanent. You're never going to get that money back.
So as always, thank you for listening to us. And if you have any questions about your particular portfolio or concerns, we do believe that we've set you up for what's to come, and we have strategies in place for how we can meet your needs. But if there's something that you think that we need to be aware of or something we need to discuss, please contact us. Thank you for listening.